What's going on, guys? D. Anthony here. We're going to go over something in this video that I still think is a little confusing to some people out there as far as strategies or just terminology in general when it comes to trading. What we're going to be covering here is what is confirmation. So in my videos, in my strategies, I always use the word confirmation. What does that exactly mean? So when we're looking at the particular strategy that I teach a lot on YouTube, which is the 20 SMA trend trading strategy. Why is it a trend trading strategy? Well, if we're looking at a 5-minute time frame, which what you're looking at is a 5-minute time frame, we're looking at the NQ, which is the NASDAQ futures. A trend means that we are trading over a specific trend line, a specific moving average. Whether it's simple moving average, it's an exponential moving average, it's a pivot point, it's a Bollinger Band, it's a linear regression line. It doesn't matter what support or resistance you're looking at. A trend is when something is trending over that specific level. So in this specific strategy, the trend that we are following is the 20 simple moving average. Okay, so the 20 SMA, that's the trend. We're looking at the 20 SMA. So if price is trading below the 20 SMA and then moves to over the 20 SMA, that is a short term, because we're looking at a 5-minute time frame, short term change in trend. Now, whether that price confirms means staying over that change in trend, aka 20 period moving average, aka 20 SMA, is going to determine whether we are going to take the trade. So I'll give you a little bit of an example. Notice how at 11 a.m. we had FOMC meeting, or FOMC was going on. Price was trading prior to that under the 20 SMA. By just one candle. Okay, it doesn't matter if it's trading below it for one candle or 20 candles. Doesn't matter. What you're looking for is a change in trend. So if we were previously, look at the price action, trading below, then we're trading over, and now we are back below. There's no real definitive trend going on. Came from under, over, over, under. Notice this candle at 11 a.m. starts to trade back over. So when this candle closes, it is now a short-term change in trend over the 20 SMA. So if we're looking for confirmation, confirmation is when a preceding candle confirms the high price, the top wick, the candle close, whichever is higher. Sometimes if you notice here, there's no wick. Notice this candle here. There's no wick, but there's a wick on this candle. There's a little tiny wick on this candle. Whether the price of the candle has no wick at all or it has a wick, confirmation is when the preceding candle, this candle, takes out either the high of the candle close if there's no wick, or the top wick. So your entry is when we confirm the high price or the low of the candle that closes over or under the 20 SMA, if that makes sense. So this candle at 11 a.m. closes over the 20 SMA. So we're thinking long-sided trade. We're looking for a preceding candle to confirm the high price of the candle that closes over the 20 SMA. You would be taking an entry here at 11:05. You would be using a 1-bar stop or a 20 period moving average as your stop. The choice is yours. What's the difference? Few points in this particular play. Okay. Now, when you get into position sizing, how many contracts you should be playing depends on the level of risk associated with the candle that closed over the 20 SMA. So this candle, I'm going to make this clear. This candle that closes over the 20 SMA is what I call, for terminology, your reason why candle. Okay. So your reason why candle is why you want to enter the trade. Why do we want to enter this trade long? Because the trend has changed from trading below the 20 SMA to now closing over the 20 SMA. That becomes our reason why candle. Our entry candle, right? So our entry candle needs to confirm high wick or candle close, whichever one's higher, right? Sometimes candles don't have wicks or candle close. So your entry candle would become the following candle if confirms the high wick or the close of the reason why candle. Reason why candle, confirmation candle, okay? We enter the trade on a confirmation candle. We don't enter the trade on a reason why candle. And we don't enter the trade after we already push higher than the previous price. We enter when we confirm the price. So if the price was trading at 16,670 on the candle close or the high wick, your entry is when the preceding candle takes out 16,670. Candle opens up, pushes down, starts to climb, takes out the high of your reason why candle. That's confirming the price. So you get in on confirmation over this price. Your stop loss is down here, 1 bar stop. On this particular play from 16,590 all the way up here to 16,670, you are looking at an 80-point reason why candle. Now it's up to you. Again, this is news. Not every candle is going to be 80 points, so don't put your panties in a bunch. But for the sake of this video, for the sake of this training, this reason why candle is giving you a stop loss of 80 points. What you need to understand is, do you want to be in this trade for an 80-point stop loss? If the answer is no, go sit on your hands. Do whatever you want to do. Don't take the trade. If you want to take the trade and you want to participate, what you need to do is some very quick math in your head, and you need to analyze how much risk are you going to take if this trade does not work, okay? So in this particular situation, if you were to trade 1 micro contract, 1 micro equals an $160 loss. So if this trade does not work, 1 contract is going to lose $160. Plain and simple. 2 contracts is going to lose double 160. Makes sense? I don't know if you guys can see that. Does that make sense? 1 contract is going to lose $160 on an 80-point stop loss. 2 contracts is going to lose 2x at 160, okay? So you're going to lose $320 on 2 contracts. Now, based on how much risk you want to put on the table is going to determine how many contracts you can trade. Now, because this is an FOMC candle, it's exaggerated. Most of the time you're looking at a 15-point stop loss, a 25-point stop loss, a 30-point stop loss. So what you would do is analyze how much do you want to lose on the trade, and then that's going to determine how many contracts you play. And we are going to target a 1-to-1 at least. If you want to make more than 1-to-1, you need to be able to afford playing multiple contracts. And what you would do is when the price hits a 1-to-1 risk to reward ratio. So for this example, if we hit 80 points profit and we're trading 2 contracts, we sell 1 we move our stop loss to break even, and then we sell as that candle continues to go. So if we get 2R, or if we get 1.5R, if we get 3R, we can sell at any point in time. We're protected. We've locked in $160. Does this trade go for 80 points? Well, let's find out. So let's clear everything off the screen. If our entry price is going to be here, 16,670, then we need to go up 80 points, and that's going to be our 1-to-1 risk to reward ratio. So from a price of 16,670 to 16,730 is 60 points. We would be looking for 750 to be 80 points. So your 1-to-1 take profit was here on this candle. Okay, this is your 1-to-1. This is our risk. This is our risk. This is our entry. This is our reason why candle. This is our confirmation candle. Confirmation means taking out the high. Since we're going long, it's taking out the high of the previous candle. We enter on a confirmation candle. Our reason why candle's low becomes a stop loss. We're targeting a 1-to-1, and you would have taken $160 on one micro trade. Okay. Let's play a scenario out that doesn't work. This play is going on currently. So notice this 20 SMA play, entry is at 16,691. It gets confirmed, meaning the preceding candle takes out the low. However, quickly comes back around. Your stop loss is here over your reason why candle, and your close over your reason why candle is your stop loss. So on this particular play, if we look at where we closed, 16,758, your entry was 16,691. You are looking at around a 30-point loss. So if you were playing one contract, you lost $60. If you were playing two contracts, you lost $120. If you took this trade and you took this trade even at one contract, you would still be up a total of $100 on the day, taking these two trades. I'm just using these two trades as an example. This trade was a winner for $160 at one contract, 1-to-1 R to R. This trade here, if taken one contract, was a $60 loser at a 1-to-1 R to R. Makes sense? So you would have lost 60 on this trade. You would have made $100 on this trade. You would still be positive $100. But what I teach in evolution traders is to kind of stick with the trend. Stick with the trend. Okay, so the trend just from 11 a.m. is up. The pullback we want to ignore because it's going against the trend. We want to wait for the next long setup. So look at the next long setup. Stop loss 16,680. Entry price on our reason why candle is 724. Your potential stop loss was 38 points. You would be targeting 38 points on this move. That's a 1-to-1. So what are we looking for? A confirmation. What's confirmation? When price takes out the reason why candle's high. Okay, that's confirmation. We would enter here over 16,724, and we're targeting 40 points. So from 24, we needed to go up 34, 44, 54, 64. Okay, profits would have been hit here. There's 65. So this trade would have hit for a 1-to-1. So not only did you make you made 80 points on this trade, you lost 30 points on this trade. Okay, you lost, what was this one? 750 to 790. You lost 40 points on this trade. So now you just made another 40 points plus on this trade. So this short gets wiped out. This long would now put you back up 120 points in 3 particular plays. Does that make sense? That's the game of probabilities. Is every trade going to work? Of course not. Are you going to get stopped out? 100%. But how well you manage your risk to reward and how well you take these plays and you identify them is going to determine if you're going to make money. So I hope that makes sense.